Welcome back to the Deep Dive. Today, we are shifting gears a little bit. We spent a lot of time on this show talking about the flashy side of business marketing trends, the AI revolution, supply chain resilience.
All the big picture stuff.
Exactly. But today, we are going to the finish line. We are going to the absolute critical moment where all that strategy, all that picking and packing in the warehouse, and all those sales calls finally transform into the one thing every business actually cares about.
The revenue. The cash.
The cash.
It's the moment of truth. You can have the best product in the world and the most efficient supply chain anyone's ever built. But if you cannot generate a valid, compliant invoice that the customer will actually pay,
Then what do you have?
you don't have a business. You have a hobby. A very expensive hobby.
Exactly. We are stepping out of the warehouse, walking down the hall, and knocking on the door of the finance department. We are doing a deep dive into SAP SD billing document types.
Specifically, we're cracking open the master guide for transaction code. Well, the big one, VOFA.
VOFA. Now, I know what some of you might be thinking. Configuration, tables, 4-character codes. Isn't that a bit dry?
It can sound that way.
But here's the hook and why we picked this topic today. This isn't just about settings in a menu. This is about the cash part of order to cash. This is the whole point.
That's right. I mean, think about the stakes. Let's put it in perspective. If you get a sales order type wrong, in VOV8,
Okay, what happens?
maybe a truck doesn't leave on time. Maybe the wrong shipping point is proposed. That's bad. It's an operational headache for sure.
What's fixable?
It's fixable on the ground. But if you get the billing configuration wrong in VOFA, you are messing with the general ledger. You're not just late with a box. You are potentially inflating your company's turnover figures artificially.
Wow.
You might be failing to comply with tax laws in Italy or India, which can lead to massive fines. Or, on a simpler level, you are just creating an absolute nightmare for the accountants who have to reconcile the books at the end of the month.
So the stakes are, well, their financial survival, essentially.
Extremely high. It's the difference between a clean audit and a qualified one. So the mission for this deep dive is to take you from, let's say, a functional consultant mindset where you just know where the fields are to a solution architect mindset.
Okay, what's the difference there?
We want you to understand the why, the financial impact, and the strategic design behind every single checkbox in VOFA. Not just what it does, but why you would choose one option over another based on the business's needs.
I love that distinction. We're moving from how do I configure this to how do I design a financial solution that actually works.
That's the goal.
So let's define our scope immediately so we don't get lost in the weeds. We are not talking about sales document types here, are we?
Correct. And that's a crucial distinction to make right up front. Sales document types, which you configure in Transaction VOV8, they're all about logistics. They control things like availability checks, delivery scheduling, shipping points, route determination.
The physical movement of goods.
Exactly. That is the operational side of things. Billing document types in VOFA, on the other hand, are the integration bridge. They are where logistics hands the baton to finance.
A handshake.
The handshake. They focus on account determination, financial posting, settlement, and taxes. It's all about the money.
It's the handshake between the boxes on the truck and the numbers in the books.
Precisely. And if that handshake is weak, or if the data doesn't map correctly, you drop the baton. And when you drop the baton at this stage of the race, well, nobody gets paid.
Okay, let's unpack this. We're going to walk through the configuration screen of VOFA section by section, just like a consultant would. And we have to start with what our source material calls the DNA of the document, the general control section.
Right at the top. When you open VOFA and select a billing type, this is the first block of fields you see. And the most critical field here, the one that essentially defines the physics of the document, what it is the SD document category.
The technical name for that is?
VBTYP. VBTYP. If you're ever looking in the tables, that's the field that matters more than any other.
VBTYP. The source uses a great analogy here, which I love. It says you can label a jar sugar, but if the contents are salt, you are going to ruin the cake.
That is the perfect way to describe it. In SAP, you can go and create a new billing type. You can call it, super special credit memo for damaged goods. You can name it whatever you want in that text description field.
Right.
But if the SD document category behind the scenes is set to M.
And M stands for?
M is for invoice. If that category is M, the system acts like it's an invoice, full stop.
It completely ignores the label on the jar.
Completely. It looks at the chemical composition. It doesn't read your friendly description. If the system sees M, it says, okay, I am asking the customer for money. It will try to generate a receivable. It will post a debit to the customer account. It will expect a positive value. It will update the sales information system as revenue.
It does all of that regardless of what I called it.
It doesn't care what you typed in the description field. That's for humans. VBTYP is for the system.
So this field is the hard coding. It tells the system what the document actually is and what it needs to do. What are the key values here that we really need to know?
There are really, let's say, 4 main pillars, plus a couple of others for special cases. First, you have M. That's your standard invoice, like the out-of-the-box F2 document. It drives the creation of a debit entry on the customer account. It means the customer owes us money.
Simple enough. M for invoice.
Then you have O. This is for credit memos, like the standard G2. That tells the system, I am giving money back to the customer. I'm reducing the receivable. It posts a credit to their account.
Okay, invoice and credit memo, the 2 basic sides of the coin.
Right. Then you have what I like to call the undos. You have N, which is an invoice cancellation, like the S1 document type. Its whole purpose in life is to reverse an M document.
And for credit memos.
You have S, a credit memo cancellation, like S2. Its job is to reverse an O document. So M and O are the primary transactions, and N and S are their direct opposites, their cancellations.
So why is this precise categorization so important? I mean, why can't I just create an invoice with a negative number to give a credit?
That's a classic question. The reason is the document flow. In SAP, there's a table called VBFA, which is essentially the audit trail for every single sales transaction.
The history of everything.
It's the complete history. It shows the links. This sales order led to this delivery, which led to this invoice. If you start mixing these categories up, if you try to use an M category for a return process, for example, you are going to completely break that audit trail.
How so?
The system will get confused. It might think you're billing the customer a second time for the same goods instead of crediting them for a return. Your inventory values might be correct because you processed the return physically, but your financial postings will be backwards.
And the reporting.
Your sales history reporting will be completely corrupted. You won't be able to distinguish new sales from corrections. It becomes an analytical nightmare.
So rule number 1, don't mess with the DNA. Get VBTYP right. Make sure the category matches the business intent perfectly.
It is the absolute first thing you must get right.
Now, right next to that, in the configuration, we have the transaction group. This feels a bit more administrative. The source material calls it the filter.
It is administrative, but it solves a very specific and very annoying problem that consultants face all the time. Imagine the scenario. You have a user calling you up. They are furious. They say, I ran the billing due list in transaction VS04, which I do every single day at 5 o'clock, but my service invoices are not showing up. I can't bill them.
Okay, a classic user complaint. The system isn't working.
Exactly. And you go and you check the system, and the orders are there. They're ready to be billed. The status says relevant for billing. Everything was absolutely perfect from the order's perspective.
But VS04 is blind to them.
Completely blind. The user runs the list, and it comes back empty.
Why? What's happening?
The issue, 9 times out of 10, is the transaction group. This field allows the system to partition documents for collective processing. It's a way of sorting the work pile.
So you can process different types of billing separately.
Precisely. Standard delivery-related billing, your F2 invoice for widgets leaving the warehouse, that usually has transaction group 7. But order-related billing like a credit memo request or a service invoice where there's no physical delivery, that might use transaction group 8.
Okay, I see where this is going. If the user's background job, or maybe their personal screen variant in VS04, is only set to look for group 7.
They will never, ever see the group 8 documents. They're invisible to that specific run.
It's like they're looking in the wrong filing cabinet.
That's a perfect analogy. It's a mechanism to separate workflows. You might want one background job running every hour to bill physical goods that have left the warehouse. That's group 7 because that's high volume and time sensitive. And you might have a totally different job that runs once a week to bill service contracts, which is group 8. The transaction group is how you keep those 2 streams separate so they don't clog each other up.
That is a fantastic troubleshooting chip. If a document isn't showing up in the billing due list, check the transaction group.
First place I'd look after confirming the document is actually ready to be billed.
Right. Moving down the screen in VOFA, we hit the document type field. Now, this is not the SD document type. This is something different. This is where things get really interesting for the accountants. This is the link to the FI document type.
This is the handshake we were talking about earlier.
Yeah.
This is the explicit connection. When you save a billing document in SD, the system needs to generate a corresponding accounting document in FI, but it needs to know what kind of accounting document should I create.
And the standard setup is that an F2 billing document in SD creates an RV document in finance.
Right. RV is the standard SAP code for billing document transfer. And look, it's fine. It works perfectly well. But here is where a solution architect adds real value and thinks beyond the defaults. Imagine you're the controller for a massive multinational company. You have thousands and thousands of RV documents hitting your general ledger every single day from standard customer sales. But you also have intercompany billings, one subsidiary billing another, and maybe you have third-party drop shipments, and maybe some other special processes.
And if they're all just labeled RV, they all look exactly the same in the ledger.
They're desperately samey. If the controller wants to see how much money subsidiary A owes subsidiary B, they have to run a huge report, export maybe 50,000 rows to Excel, and start filtering by customer number and trying to figure out which ones are the internal ones. It's a massive waste of time.
A manual reconciliation nightmare.
Totally. But in VOFA, for your intercompany billing type, let's say the billing type is IV, you can change this document type field. Instead of RV, you can point it to a custom FI document type that you've created, like ZI.
So now, when an intercompany transaction happens, it's not stamped with RV, it's stamped with ZI.
Exactly. So now the accountant opens their ledger report, filters by document type ZI, and boom, they're all the intercompany transactions, perfectly isolated from the sea of standard customer sales.
You've just saved them hours of work every month.
You've made their month-end reconciliation 10 times faster just by changing one field in VOFA. And it's not just for reporting. This FI document type also controls the number range of the accounting document and even which account types like customer, vendor, GL are allowed in the posting. It's a powerful piece of control for the finance team.
I love that. It's about having empathy for the person downstream from your process, thinking about how to make their life easier.
That's what a good architect does.
Now, speaking of accounting headaches and local requirements, let's talk about negative posting. The source material calls this the legal eraser.
This sounds interesting.
This is fascinating, and it's a concept that really depends on where you are in the world. It's a great example of global versus local requirements. In the US, for example, if I send you an invoice for $100 and then I realize I made a mistake,
I will typically issue a credit memo for $100. On the books, if you look at the ledger, I have a debit of $100 and a credit of $100.
which nets to zero, so the balance is correct.
Balance is correct, yes. But the turnover figures, the total volume of activity on the account show $200 worth of movement, a debit and a credit.
Okay, I'm with you.
In many European countries, specifically places like France and Spain, that is a big problem. Their JAP, their generally accepted accounting principles, says you should not artificially inflate turnover just because you made a typo.
They view that $200 volume as false data. It didn't really represent $200 of business activity.
Exactly. They see it as misleading. They want you to effectively erase the mistake, not counteract it with an opposing entry. And that is what the negative posting checkbox does.
So how does it work technically?
Instead of posting a credit on the other side of the ledger, it posts a negative number on the original side, the debit side. It mathematically reduces the original entry back to zero.
So the volume, the turnover, stays at zero, not 200.
Precisely. It keeps the turnover figures pure and uninflated. And look, if you are doing a rollout of SAP in Europe, this checkbox isn't a nice-to-have option, it's a legal requirement. If you miss this in your design, your system is non-compliant from day one.
That is a massive gotcha if you don't know your local laws.
Wow. Okay, let's look at two more controls in this general section before we move on. Branch head office and credit memo with value date.
Right. Branch head office is all about a very common business structure who actually owes you the money. Imagine a large retail chain. They have a head office that, for simplicity, usually pays all the bills for every single store to centralize their cash flow.
Okay, so in your customer master data, you'd have the individual store, the ship to, and then you'd link the head office as the payer.
Correct. So normally, I bill the store for the goods they received, but the system automatically posts the debt, the receivable, onto the head office's account. That's standard behavior.
But let's say this one specific store is a franchise. They handle their own finances, they pay their own bills directly. If you check the branch head office box in VOFA for a specific billing type,
It changes the behavior.
It acts as an override switch. It tells the system, for this transaction, ignore the master data hierarchy. Force the posting to the branch, which in this case is the pair on the document, the franchise store itself.
So it's an exception handling mechanism built right into the configuration.
It is. It allows you to handle those one-off scenarios without having to go back and rewrite your entire master data strategy for that customer. Very useful.
Okay, and what about credit memo with value date?
This one is subtle, but it's all about fairness in payment terms and aging. Let's say I invoice you on January 1st, and you have 30 days to pay. The value date of that transaction is January 1st. That's when the clock starts ticking for payment terms.
Right.
On January 25th, you call me and say I overcharged you by $10. So I agree to issue a partial credit memo for $10.
Okay.
Now, if the credit memo with value date box is unchecked, that credit memo gets today's date, January 25th, as its value date.
So the clock for that credit starts then.
For that credit, yes, which can mess up interest calculations and aging reports. But if the box is checked, the credit memo inherits the value date of the original invoice it's referencing, so it gets January 1st.
I see. So it prevents the customer from essentially gaining an extra 25 days of float just because there was a correction.
Exactly. It keeps the aging accurate and ties the credit financially back to the exact date of the original transaction. It's about maintaining financial integrity.
Okay, that covers the general control section. We've set the DNA, we've handled the handshake with finance. Now we need to move to what our outline calls the brain of the operation. Section 2, account determination and pricing. This is where the money actually finds its home in the ledger.
It is. And this is, by far, the most common place where billing fails. You try to release an invoice to accounting and you get that dreaded, horrible error. GL account not found.
The classic error. Every SD consultant has seen that thousands of times.
No.
And the first place you should look is the account determination procedure field in VO-DO.
It's step 1. This field assigns a procedure, like the standard one, KOFI 0. Think of this procedure as a recipe book or a list of instructions. It tells the system, okay, I need to find a GL revenue account. Here's how you do it. First, check for a combination of the customer account assignment group and the material account assignment group. If that doesn't work, check this other combination.
It's a search strategy.
It's a search strategy. And if this field in VOFA is wrong or blank, the system is looking at the wrong map. It doesn't even know where to begin its search.
So it just gives up and throws the error.
Exactly. Now, for standard GL posting, we usually use KOV 100. But if you are doing profit center accounting and you need deep integration with the controlling module, the CO module, you might use KOFK00.
What's the difference? The K.
The K is the key. KOFK includes the logic to check for things like cost centers or profit centers that KOFI might skip. It's designed to pass more cost-relevant information over to the controlling side of the house.
So if your finance team is complaining that costs aren't flowing to the right profit centers from your sales, a good place to check is whether you're using the K procedure instead of the standard one.
Absolutely. It's a classic integration issue. And, connected to this right there in the same block is the document pricing procedure. This is just a single character key, usually A, for standard invoices, but it is part of a very, very important formula.
The source material lays this out clearly. Sales area plus the customer pricing procedure from the customer master plus this document pricing procedure
Equals the final pricing procedure that the system will use for that document.
That's the magic formula. And the document pricing procedure is the specific variable that the billing type controls. So why would we need to change it? Why not just use A for everything?
That's a great question, because sometimes the context of the billing changes the entire pricing logic. Think about a warranty invoice.
Okay, so I'm replacing a broken part for free.
Exactly. You are sending a document to the customer to record the exchange of the part, but you don't want to charge them a single penny. Now, the standard pricing procedure, the one used by A, is designed to find a price.
It wants to find that $100 for the part.
Right. It's looking for condition records like PR000. But for a warranty, maybe you want a completely different pricing structure. One that, for example, automatically applies a 100% discount to everything, no matter what. No questions asked.
So you could build a separate pricing procedure for that.
You can. And you assign it to a new document pricing procedure key, say W for warranty. Then you assign W to your warranty billing type in VOFA. Now, whenever you use that billing type, the system completely ignores the standard pricing and uses your special everything is free warranty logic.
So instead of trusting a user to remember to manually zero out prices or apply a discount,
The configuration does it for you. automatically and reliably. It drives automation and dramatically reduces user error. Same logic applies for things like intercompany billing, which might use I to trigger special internal transfer prices.
I see. So it's a switch to fundamentally change the financial calculation based on the business process.
That's it. Now, in this same section, there are a couple of other crucial fields. We have output determination, which is pretty straightforward.
It's how the bill gets to the client, right?
Yep. Print, email, EDI, XML. The procedure assigned here controls which output types are proposed. One little expert tip. You'll see fields for both header and item output. Item-level output is almost never used in standard billing. It's almost always driven from the header level.
Good to know. Don't get lost configuring the item level if you don't need to.
Mm-hmm.
But now there's a field in this section called reconciliation account. The source material calls this the danger zone. Why is it so dangerous?
It is extremely dangerous because it allows a user to manually override the fundamental link between a customer and the general ledger. Normally, the reconciliation account, the main accounts receivable account, is pulled directly from the customer master data. That is the single source of truth.
So if I sell to customer A, a domestic customer, it automatically goes to the domestic receivables GL account because their master data says so.
Correct. It's locked down. It's controlled. It's consistent. But if you enable this determine reconciliation account checkbox in VOFA, you are allowing the user to manually enter a different GL account in the billing header screen.
Oh, wow. So a user in the billing department could accidentally, or I suppose intentionally, post a receivable to a completely wrong account, like post it to the intercompany receivables account.
Yes, or to a suspense account, or anywhere, really, and that creates a reconciliation nightmare. Suddenly your subledger, the customer accounts, won't match your general ledger. The auditors will have a field day with that.
So the advice is, keep this turned off.
Keep it turned off for standard users and standard processes. The only valid use case, really, is for very specialized adjustment billing types used by the finance team. Let's say you need to write off a bad debt for a customer.
No.
You don't want to change the customer's master data just for this one transaction, so you might use a specific billing type where this field is open, and a trained accountant can then force that single document to post directly to the bad debt or write-off GL account.
I see. So it's a powerful tool for exceptions, but you have to use it with extreme caution. Only for the cleanup crew, not the daily users.
Exactly. Lock it down.
Okay, that makes sense. Let's move to Section 3. Structural mechanics. This covers number systems and partners. And here we run into another one of those legal compliance traps, number ranges and buffering.
This is a classic conflict in the IT world. It's the battle of performance versus compliance. In SAP, you define your number ranges in transaction VN01. You say, my invoices will be numbered from 1000 to 1999. Then you assign that range to your billing type in VOFA.
Standard stuff.
Right. Now, SAP has a performance-enhancing feature called number range buffering.
How does that work?
Well, instead of the application server asking the database for a new number every single time a user creates an invoice, which is a relatively slow database call, the server grabs a whole chunk of numbers in one go. It might ask the database for numbers 1000 to 1019, for example.
So it takes 20 numbers at once.
Exactly. It holds those 20 numbers in its local memory, in its RAM. When a user creates an invoice, the server just grabs the next number from its super fast local memory. It's much, much faster because it avoids all those individual pings to the database.
Speed is good. So what's the trap?
The trap is, what happens if the application server restarts? Or crashes? Or is taken down for maintenance?
Those numbers that it took
Yeah.
that are sitting in its RAM, they're just gone.
Poof. Gone forever. Let's say the server took numbers 1000 to 1019. It used 1000, 1001, and 1002. Then the power goes out. When the system comes back up, the database thinks the last number used was 1019. The next available number it will give out is 1020. The numbers 1003 through 1019 are skipped. They never existed.
So you have a gap in your official invoice sequence.
You have a gap. And in the US or the UK, that's usually just annoying. But in countries like Italy, India, and most of Latin America, that is illegal. The tax authorities require sequential numbering with absolutely no gaps.
Why is that?
They suspect that if there's a gap, you've created an invoice off the books. that you're hiding sales and evading taxes. If they audit you and find gaps, you can be hit with massive fines.
So for those countries, you have to disable buffering.
You must disable buffering for the number range object RVB leg. It's not an option. You take the slight performance hit in order to stay compliant and, frankly, to stay out of jail.
That is a critical takeaway. If you are doing a global rollout, check the local legal requirements for document numbering before you turn on buffering.
Always. It's one of the first questions you should ask in a workshop.
Now let's talk about the partners section in VOFEA. We usually think of partners, the sold to, the shipped to, the bill to, as being set in the sales order. Why do we need to configure partner functions again in the billing type?
Because the players in the game can change at the finish line. The billing document isn't always just a carbon copy of the sales order partners. The most common scenario for this is commissions.
Paying the sales team.
Exactly. You might have a sales employee or an external commission agent who gets a cut of the sale. Now, that person might not have been relevant for the shipping process, so they weren't listed as a partner on the sales order or the delivery. But now that we are billing, we absolutely need to know who they are so we can calculate their commission payment.
So we add their partner function to the billing header.
Right. By configuring the partner determination procedure on the billing type, we can ensure that this sales employee partner function is automatically copied in. Or we can even make it a mandatory field that the user has to fill in before the invoice can be saved.
So it ensures the sales team gets paid accurately.
It ensures they get paid, and it provides a clear audit trail on the billing document itself of who was credited for that sale.
Got it. So billing isn't just a copy of the sales order. It can add its own actors to the play when it becomes financially relevant.
That's a great way to put it.
Okay, moving on to section 4. With the outline calls, the escape hatch. Cancellations. We touched on this with the DNA, the NNS categories, but there's more detail here. Specifically, the cancellation billing type field.
This is a very simple but very powerful mapping field. It's a signpost. It tells the system. If a user is looking at this document and they hit the cancel button, which runs transaction VF11, what new document should I create to reverse it?
So for a standard F2 invoice, this field usually says S1.
Correct. And for a G2 credit memo, it will say S2. It's a direct roadmap from the original to its cancellation. But here is a clever security feature that is often overlooked. If you leave this field blank,
What happened?
the document cannot be canceled using the standard VF11 transaction.
Really, it just disables the button or something.
It essentially does. The system will throw an error message saying, no cancellation billing type has been maintained. The transaction stops dead. Now, why on earth would you want to do that?
I was just about to ask.
Sometimes, for legal or procedural reasons, you are not allowed to just cancel a document and make it disappear from the flow. You might be required to issue a formal, separate credit memo instead, which has its own paper trail and its own approval workflow, rather than just nuking the original invoice from a financial perspective.
I see. So leaving it blank forces the user to go through the proper, more controlled credit memo request process.
Exactly. It's a constraint that enforces a specific business process. It takes away the easy undo button.
And what about copying requirements? The source mentions routine 013. This sounds like code.
It is. It's a little piece of ABAP code, but think of it as the bouncer at the door of the cancellation club. Before the system actually allows the cancellation to happen, it runs this VOFM routine, usually the standard one, 03. And this routine checks a few critical safety protocols.
Like what?
First, it checks, has this document already been canceled? You don't want to accidentally cancel the same invoice twice.
That would be a mess. You'd be giving the customer double the money back.
A huge mess. And secondly, and this is crucial, it checks, is the accounting period for the original invoice date still open?
Protecting the closed books.
Absolutely. If you're in March and you're trying to cancel an invoice from December and the books for last year are closed and sealed, routine 013 will stop you cold. It prevents you from posting a financial document retroactively into a closed period.
That protects the finance team from having their historical reports and their certified annual statements suddenly changed after the fact.
Yes, it safeguards the integrity of the closed financial periods. It's a critical control.
Now, in this section, there is also talk of the reference number and the assignment number. The source calls this the audit trail. Why does the finance department care so much about these two seemingly simple text fields?
Oh, finance cares about these more than almost anything else on this screen. These fields, their technical names are XBLNR and ZUONR in the database, are the absolute keys for automation. specifically for electronic bank statement, EBS processing.
Okay, explain that connection.
When a customer pays you, they send a wire transfer or an ACH payment. That payment hits your bank account, and the bank statement comes into SAP electronically. The system's job is to automatically match that incoming cash to an open invoice in your ledger.
It needs to know that this payment of $500 is for invoice number 123.
Exactly. It needs a common language, a common key to match on, and the reference number and assignment number fields in VOFA control what number gets stamped onto the accounting document when it's created.
Okay, so what are the common settings?
For a standard F2 invoice, we usually set the reference field to option E, which means use the current billing document number. So invoice number 123 creates an accounting document with reference number 123. The customer sees 123 on their invoice, they quote it in their payment, and the bank statement matches 123 to 123.
Simple, clean match.
Very simple. But for intercompany billing, it gets more complicated. If company A bills company B, the internal customer, receives an invoice. To automatically match it on their side when they pay, we often set the reference to option C, which means use the delivery number.
The delivery number.
Yeah.
Why not the invoice number?
Because the delivery number is the one number that both sides of the transaction have in common right from the start. The shipping company has the delivery note, and the receiving company has the delivery note from when the truck showed up. By using C as the reference, the financial documents on both sides can be matched automatically without a human having to dig through emails to figure out which internal invoice matches which goods receipt.
That is a brilliant insight. It's about finding the one piece of data. It's a common key for both parties to enable automation.
Absolutely. If you get this configuration wrong, your crash application team will be sitting there manually matching payments all day long. If you get it right, 95% of it happens automatically while they sleep.
Efficiency through VOFA. Love it. Okay, section 5, a big one. To post or not to post. The posting block.
This is a single, simple checkbox, but it fundamentally changes the workflow of billing. If the posting block is checked, when a user saves the billing document, it is saved successfully in the SD module, but it does not get released to accounting.
It stops at the door to the finance department.
Exactly. It creates the document, gives it a number, but it sets the accounting status to blocked. No journal entry is generated. The revenue is not yet on the books.
Why would you ever want that? I thought the whole point of billing was to get the revenue on the books as fast as possible.
There are three main strategic reasons. The first one is performance. Imagine you're a big utility company or a telco. You are generating 500,000 invoices in a single night during your bill run. If the system tries to create the SD document and post it to accounting for every single one in real time,
It would be a massive load on the system.
it could choke the system. The database would be struggling with all the simultaneous reads and writes to both the SD and FI tables. So you use the posting block. You generate all 500,000 SD documents very quickly. Then in the middle of the night, you run a separate controlled batch job program, RV60 AFS under 0, to release them to accounting in managed packets. It smooths out the system load.
Smart. It separates the two heavy tasks. What's the second reason?
Quality control. Maybe you have very high-value, complex invoices that require a manual price verification before they hit the books. You let the system generate the bill, but it automatically goes into the block status. A manager can then come in, review it, check the prices, and then manually release it to accounting. It builds an approval step into the process.
And a third reason.
Error handling. This one is my favorite because it makes life so much better for users. It separates the sales workflow from finance errors. If the posting block is unchecked, which is the standard behavior, and there's a finance-related error, like a closed period or a missing cost center,
The user can't save the invoice.
the user often cannot save the billing document at all. They get a hard error and they're stuck. So the sales workflow stops dead because of a finance master data problem.
And the sales user can't fix that.
No. So they have to call someone in finance and wait. But if you use the posting block, the SD document saves successfully. The sales team is happy. They did their job. The document simply sits in the blocked list, which is transaction VFX3. Then the finance team can go into VFX3 as part of their daily work, see all the blocked documents, see the clear error message, fix the master data, and release it.
It decouples the two departments. It prevents a bottleneck in one from stopping the other.
Precisely. It keeps the logistics and sales process moving, even if the accounting master data needs a cleanup. It's a much smoother workflow.
That is a really strategic use of a simple checkbox. Okay, we are entering the final stretch. Section 6, expert gotchas, and special scenarios. These are the things that trip people up, even seasoned consultants.
These are definitely the ones that you usually learn the hard way, often after a botched go live when the business is screaming at you.
All right, let's start with the first one. The pro forma trap.
Ah, the pro forma invoice. These are usually document categories F5 or F8. The whole point of a pro forma is that it's a dummy document. It's usually used for customs purposes to declare the value of goods that are crossing a border, but it is not a demand for payment.
So in VOFA, the setup usually reflects that by not posting to accounting.
Correct. The FI document type field is usually blank. But here is the trap. The SD document category for a pro forma is U. And the behavior of category U is that it does not update the billing status of the preceding document, like the delivery.
What does that mean in practical terms?
It means you can create a pro forma invoice for a delivery today. Tomorrow, you can come back and create another pro forma invoice for the very same delivery. You can create 100 pro forma invoices for that same delivery, and the delivery status will remain not invoiced.
It doesn't close the loop. It doesn't consume the quantity.
It never closes the loop. It is infinitely repeatable. New consultants often panic, thinking, why is this delivery still showing up in my billing due list? I just billed it. But they didn't. They only created a pro forma. You haven't actually billed it for real until you create an F2 invoice.
And related to pro formas, there's a point about statistics.
Yes. In VOFA, there is a statistics checkbox. For a real F2 invoice, it's checked, which means the value of the invoice updates the Sales Information System, SIS, for reporting. For pro formas, it must be unchecked. If you check it by mistake, you are updating your sales history with dummy revenue from a non-financial document.
So you'll double count your sale.
You'll double count everything, once for the pro forma and then again for the real invoice. That would be a disaster for reporting. Imagine trying to explain to the CEO why your reported revenue just dropped by 50% after you fixed the report by excluding the pro formas.
A career-limiting move. Okay.
Yeah.
Next gotcha.
Invoice lists. Invoice lists are used when a customer, usually a large retailer with many locations, wants one summary document at the end of the month that references all the individual invoices you sent them that month. It's like a cover sheet for payment.
And the gotcha here is where the control for this sits.
Exactly. There is an invoice list billing type you configure in VOFA, usually LR or LG, but the switch that enables a customer for invoice lists isn't in VOFA at all. That flag is on the customer master data on the billing screen.
So you have to set it up in two places.
It's a two-step process. You have to flag the customer and you have to configure the billing type. And the dates and taxes of that final summary document are controlled by the settings in VOFA for the invoice list type. You have to coordinate the master data and the configuration.
Don't look for the on switch in just one place. Good tip. Now, intercompany billing. You mentioned earlier that this works in reverse. You unpack that.
This one breaks people's brains a little bit at first. The scenario is, company code A is delivering goods to an external customer, but the goods are actually coming from a plant that belongs to company code B. To keep the books straight, company B needs to bill company A for the goods.
Right, an internal sale.
So the customer on the IV billing document is actually company code A.
The internal company, not the final external customer.
Right. You are billing the sales organization of the ordering company. It's an internal financial settlement. So in VOFA, the partner determination for the IV type must be set up to find an internal customer number that represents that sales organization. It's not the external guy who bought the widget. It's your own sister company.
You are billing yourself, in a way.
You are billing a different legal entity within your own corporate group. If the partner determination isn't set up to look for that special internal connection, the document will fail every time because it can't find the right customer.
Okay, that's a critical distinction. And finally, the last scenario, cash sales.
Yeah.
EV.
This is the classic counter sale. A person walks into your parts depot, buys a filter, pays with a credit card or cash, and walks out with the part.
The goods are gone, the money is already in the till.
Exactly. So the billing type BV is usually configured to print immediately because the customer is standing right there waiting for their receipt. But the key difference is the account determination. Since they've already paid, we do not want to post this to accounts receivable.
Because there's nothing to receive.
There's nothing to receive. We don't want to chase this person for money they already gave us. So the account determination in VOFA for this billing type is set up to direct the posting to a cash clearing account or a petty cash GL account, completely bypassing the standard AR subledger.
So VOFA is smart enough to know, don't send a collection letter to this guy.
If you configure it right, yes. It posts the money directly where it belongs without creating a phantom debt.
This has been an absolutely incredible tour through a single transaction code. We've gone from the DNA of the document through the financial handshake, the structural traps, and all these expert gotchas.
We really have, and I hope the listeners can see now that VOFA isn't just a boring list of checkboxes. It is the central control panel for the financial health of the entire sales process.
It really is. So, to wrap this up, we have a challenge for you, the listener. We're calling it the Unit Test Challenge.
Yes. Listening is great, but doing is where the learning really sticks. If you have access to a sandbox system or an IDES system, I really want you to try this.
What's the assignment?
I want you to go into VOFA, copy the standard F2 billing type, and create a new custom one. Call it ZEXP for experiment.
Okay, ZEXP. I've got my new billing type.
Now, I want you to deliberately break it, go to the account determination procedure field, and assign a procedure that doesn't exist or one that's completely wrong for your setup.
Break the financial map.
Break the map. And for the second step, check the posting block checkbox.
Okay, so it's broken, but it's set to be blocked.
Exactly. Now go through the process, create a full order and delivery, and then create a billing document using your new broken ZEXP type. It will save because the posting block will allow the SD document to be created.
And
Then go to Transaction VFX3, the list of blocked documents, find your invoice, try to release it to accounting.
and watch the fireworks.
And read the error log. Click on the red lights. Analyze exactly what the system is telling you. That experience, seeing the error, tracing it back to the specific field you changed in VOFA, that's the only way to truly internalize how these controls work in practice.
It's one thing to know that it breaks. It's a completely different thing to see how it breaks and read the system's explanation.
Exactly. Become the master of the error log. That's how you become a real
Hey,
expert.
love that. Become the master of the error log.
Hmm.
We're going to leave you with one final thought to mull over. We often talk about automation these days as something involving robots or AI. But in the world of SAP, a billing type is effectively an automated accountant.
It is. It makes hundreds of micro decisions on dates, on GL accounts, on taxes, on partners, on output. It does the routine work of a human accountant, but it does it thousands of times a minute with perfect consistency.
So when you are in VOFE configuring a billing type, you aren't just setting up software. You are training that automated accountant. You are teaching it the rules. You are telling it how to behave financially.
Treat it with that level of respect and design it with that level of care, and your month-end close will be a breeze.
Thanks for diving deep with us today. Go break that ZEXP document, and we'll see you on the next deep dive.
Happy configuring.